Hello, welcome back. Here is Ali Talabi, and we're going to wrap up our Module 8 regarding capital budgeting. I'm going just to provide you some hints and notes related to capital budgeting. Then, as I promised, I'm going to show you how to use your financial calculator, more specifically the BA2 Plus. We are going to use this for Npv and Irr, so have your financial calculator ready and follow the steps. And finally, I'm going to show you a few questions and I will provide you the answer. I hope you enjoyed this session. So let's start with looking at some hints. So we talk about different criteria which we use to choose the right project. So we talk about the payback period, discounted payback period, NPV, IRR, PI. So among those, it seems NPV and PI are more reliable. However, remember, depending on your objective, depending on the limitation you have, you might prefer to choose another approach. So in some cases, maybe payback period is more preferred because, as we discussed, it's more simple, straightforward, and some investors are more interested to see how soon they can get their money. Also, some investors are looking for the percentage. They want to know what is the internal rate of return. So in that case, IRR is an option. If you have the capital rationing, if you have limited budget, for sure PI is preferred to NPV because it considers the size of project. So it's better to go with profitability index than the NPV, which ignores the magnitude of the project. We didn't discuss that much regarding the discount or required rate, also called as hurdle rate. We mentioned that let's assume this number is given, but later we'll talk when it comes to cost of capital, we'll talk about discount rate, required return, and how we can measure it. But for now, remember that depending on the market, depending on the investor's preference, depending on the risk of the project, you might choose different level of a required rate. So it's not same for all the projects or for all different investors. Be careful with that. We also talk about the NPV profile. So if the discount rate is changing, so you want to see what is the impact of discount rate or required rate on the NPV, it's much easier and better to have the NPV profile. So that's a nice graph showing the relationship between the discount rate and the NPV. And for sure, as the discount rate is going up, we notice the NPV is going down. We talk about one of the major issues with IRR, and we mentioned that if the sign of cash flow is changing more than once, it means it's going from cash inflow to outflow or vice versa. In this case, you will have multiple IRR. And the maximum IRRs you will get is the number of changes in the sign of cash flows. For example, if the cash flow has 3 sign changes, it means it can have up to 3 IRRs. We also talk about a modified version of internal rate of return, which we called MIRR. We calculated the future value of cash inflows and the present value of cash outflows. When you use when you calculate the present value, we are talking about discounting, and when you calculate future value, we're talking about compounding. Remember, for discounting and compounding, we are not using the IRR. We are using the required rate or the rate which is asked actually by investors. So be careful with that. Don't mix them up. So in different techniques, we are using different assumptions, several assumptions, and for sure, as we have more assumptions, it means we are limiting our conclusions. So beware of the assumptions, beware of the limitations of the techniques you are using. Now the question here is, if you have different criteria, and each is leading to different answer, different project, which one you will choose? Usually NPV and PI, they have priority, and between the NPV and PI, if you're talking about different project in terms of the different size, PI is the better approach. Now let's look at the financial calculator. So have your calculator ready, and I'm going to show you how to use your BA2 Plus to find the NPV and IRR of a project. So as I promised, I'm going to show you how to use your calculator, and I mean financial calculator BA2 Plus to actually calculate NPV and IRR. Let's go with a very simple example. As you see here, we have an initial investment of $100, so that's a cash flow year 0. 1 year from now, you're getting back $70. 2 years from now, you're getting back $50. Let's assume your appropriate discount rate is 10%, and based on this, we are going to calculate NPV and IRR. So in your calculator, mainly we are going to deal with the cash flow key. As you see, there is on the second line or row, there is a cash flow CF button. You are going to use that most of times to enter the cash flows. After entering all the cash flows, you are going to calculate NPV and IRR. So let's go with the cash flow first. So as soon as you hit the CF, it's showing the CF0 or CF no, which is your initial investment. So what is that? Is $100. So you enter the dollar value, which is $100. However, this is $100 negative, so you have to hit the plus minus button here. As you see, it gives you minus $100. Don't forget to hit the enter key after that to enter the number. Now you have the initial investment. Now you have to move between the cash flows up and down. So when you go down, it means you go to the next cash flow. When you go up, it means you go back to the previous cash flow. So down, it's the first line. You see there is a down here. So I go with down. It's showing the CF CO1, which is your CF1, so your first cash flow. It is 70, and again, don't forget, after entering the cash flow, don't forget to hit the enter. So I hit the enter. So as soon as I hit the enter, you see it's showing $7 CO1. When you go down, so you have to enter all the cash flows before going to the NPV calculation, you see there is showing FO1. What is that? That's a frequency of cash flow. In some cases, you have same equal cash flows for several periods. If that's the case, you can use the this function and you can enter the number of same equal cash flows. But for now, just make it simple. You don't want to make it complicated. Leave it as is. Just frequency is 1. So we move to the next period. So I go down again. So I go down. I enter the cash flow in year 2, which is 50. So 50, enter. It shows the CO2 as 50. After entering all the cash flows, now you need to hit NPV. So you hit the NPV. You see in the second row there is an NPV. So I hit the NPV. As soon as you hit the NPV, it is asking you for the discount rate, which is I. What is your I? What is the rate? In our case, is 10. So I hit enter. Again, I never forget to hit the enter. So enter, and then keep going down. Keep going down. After entering the discount rate, keep going down. And now it shows the NPV, but this is uncalculated NPV. If you calculated the NPV before, this is the old one. Make sure you hit the CPT, which is the compute key, on the first line, and it shows the new NPV. For this project, you see the NPV is 4.96. So that's the NPV for this project. Since this is greater than 0, it means you will accept the project. What about the IRR? We already entered the cash flows for this question. We don't need to re-enter. It's already in the memory of the calculator. The only thing you need to do is you go to the IRR function. So you hit the IRR function here. Now, again, after hitting the IRR, don't forget to go with the CPT compute. So you hit the CPT or compute key, and in this case, it gives you the internal rate of return. Sometimes it takes 1 or 2 seconds because it's a kind of matter of computing and finding the discount rate. So it might take a bit longer. So it gives you the discount rate or IRR in this case, which is 13.89, almost 13.90 because it's 898. So it's 13.9%. Now, based on the IRR rule, this 13.9% is greater than 10%, which means we'll accept this project. Now let's look at the questions we have here. So let's look at the first question. Here we're looking for the discounted payback period. We talk about this and we mentioned this is a kind of upgraded version of payback period in which we are addressing the issue of time value of money, but still we have one of the major issues which we had before. There is a cutoff point in discounted payback period and we ignore all the cash flows after the cutoff point. And be careful here, we're looking for the incorrect statement, not the correct one. A is saying it incorrectly rejects some positive NPV projects, which is true because if your cash flows are happening after the cutoff point, you might end up having some positive NPV project, but since you're ignoring those cash flows, you might reject the project. B is saying it includes all cash flows, which is not correct. And this is our answer. B is the answer because there is a cutoff point and you ignore all the cash flows after that, so you don't include necessarily all the cash flows. What C, it is better than the payback period, which is correct. It actually addresses one of the major issues with the payback period, which is time value of money. So this is a better version of the payback period, but it still has some issues. So C is still correct. A is correct. So the only incorrect statement is B. So our answer here will be B. Let's look at the second question. If a project has an IRR of 20%, then its NPV will be. So we mentioned that as the discount rate is going up, the NPV is going down. So if a project has IRR of 20%, it means for any rate, discount rate, which is greater than 20%, the NPV becomes negative because the 20%, that's the exact rate which gives you zero NPV. So if the rate goes about 20%, the NPV becomes negative. If the rate comes to the below 20%, if the rate is less than 20%, the NPV becomes positive. So let's see which one are telling us this. Impossible to determine, which is not correct. Positive at discount rate of 10%, correct. So if your discount rate is 10%, your NPV becomes positive. But be careful, always read all the answers. Just don't go, oh, B is the correct answer, I'm done. No, let's go to the C. Negative at a discount rate of 25%. This is also true. If the rate is going above 20%, the NPV becomes negative. Both B and C, which is correct. B and C both are correct. So the answer should be D, not B, not C, both. So which is D. Now let's look at the third question. What is the equivalent annual cost for a perpetual project that requires $40 initial investment and $10 annual operating expense? So we talk about the equivalent annual cost. Here you have to be careful because you are going just to generate the equivalent or equal payments which are happening forever. This is the perpetuity. So let's look at the numbers here. So you are investing $40 now, correct? However, you also need to pay $10 forever. So this is happening forever. This is perpetuity. So what you can do, you can find the present value of all these future cash flows. And we'll learn in module 5, the present value of the perpetuity is the payment divided by the discount rate or required rate. The payment here is $10. What is the appropriate discount rate? 10%. So this gives you $100. So in other words, this $100 current value is equivalent to same $10 payment forever. You're also paying $40 now. What is the present value of all these payments? So $100 here, $40 here. So the present value becomes $140 negative. So now you haven't done yet. We are looking for the EAC or equivalent annual cost. Which payments or which type of cash flow which gives you the same present value? You're right. We'll learn again the present value of the perpetuity is the payment over R. Here, your payment, that's the EAC. That's the same equal payment. So it should be PV times discount rate. I'm just rearranging the formula. We just calculated the PV as $140 and your discount rate here is 10%. You tell me, what is the equivalent annual cost or the payment in this case? You're right, $14. So that $14 pay a call payment for the unlimited period of time, that's equivalent to $140 now. So the answer should be D. Now let's look at the last question. Now we talk about the issue with IRR, and we mentioned that you might end up having multiple IRRs. And this is very common when the cash flow is, the sign of the cash flow is changing more than once. Now, if you look at this project, these 4 projects, you will see that A, B, and C, actually A, B, and D are changing the cash flows just once. You see, for example, in A, you are going from negative to 200, 200 to 100, so there's just one changes in the cash flow. B is changing from minus 100, 0, 0, 200. Be careful, that's a 0, so it's not a negative. So still the cash flow is changing just once from negative to positive. However, if you look at C, you see it's changing once here, it's changing another time here, it's changing another time here. So it's a 3 changes. And finally, D is changing just once, which has 1 IRR. So the answer here should be C. You have multiple IRR for the case of C. Thank you very much. That's it for today. Have a wonderful day. Talk to you soon and enjoy your day. Here is Ali Talabi.